Well, thanks for attending the conference, World Biomarkets 2023. I think we can break this with a great panel that we have assembled here. The structure of the panel will be like this. I will quickly introduce our panelists, then we go into a Q&A, and please think about some good questions that you have. Take the opportunity to pick the brains of these brilliant people so that we can come out and with a coffee and have a good after chat. Okay, thanks. So my name is Ludwig Goris. I'm investment director and partner at Capricorn Partners. We are an asset manager based in Belgium, and we have been focusing on the bioeconomy for a long time, since the 2000s. We don't only invest in the bioeconomy, we have digital funds and health funds, not so relevant for the topic of today, but let's say around $500 million of assets under management. I think we are a nice boutique, mid-sized venture capital managing company in Europe, but with a focus on the globe, also North America and Middle East. Okay, so we have here with us, I'll start with the ladies first, of course.
Again.
Madelon Bangma from the Unknown Group. We have Wehbring from Bioeconomy Capital. We have Josko Bobanovic from Sofinnova, and we have Stéphane Roussel from the European Circular Bioeconomy Fund. All partners at these organizations are really here at the top of those companies. So please, Madelon, if you could start with quickly introducing yourself, and we just go here counterclockwise, and then we'll take it off.
Yes, I'm Madelon. I'm the partner and CFO of Unknown Group. You were asking me already, was it really the name Unknown Group? Yes, because we go beyond known, we say. We fuel founders to fix the future, because if we live like this, the future will be broken. So we need to fix it, and we need founders for that, together with industry leaders to scale up their solutions. We are an early stage investor, so between 50,000 to 1 million, and then we give it over to the bigger investment companies. On the other hand, we just opened an innovation hub around the corner, the Titan, where we host more than 60 companies, early stage, and also give the room to products for more than 200 companies. So if you are interested, just touch on my jacket or my colleagues of Unknown Group.
Excellent. My name is Wehbring. I'm part of Bioeconomy Capital. I believe we were the first synthetic biology VC firm. Started really thinking about this back in 2005. And for companies and people in the audience, our target is definitely seed, Series A, early stage investing, and then again, we pass it on to those who can scale it up.
Good morning, Josko Bobanovic. I'm part of Sofinnova Partners. Sofinnova Partners is the oldest venture capital group in Europe, 51 years old this year. We manage 2.5 billion across 6 different strategies, encompassing different areas of life sciences. Our group started 13 years ago, investing in biotech-enabled sustainable solutions in food, ag, chemicals, and materials. We have 24 investments behind us, spanning everything from just starting to publicly traded and bankrupt in between. We invest early stage, initial tickets 1 to 10 million, Europe and North America, and we work closely with our startups to help them grow as they mature.
Well, thanks for hosting me. I'm Stéphane Roussel. I'm a partner at the European Circular Bioeconomy Fund. We are a growth stage investor. We support transition from a linear fossil-based economy to a circular bio-based one. We are solely focused on the bioeconomy. We are a European fund. By our mandate from the European Investment Bank, which was our cornerstone investor, we invest solely on the European geography, and we support, visionary entrepreneurs that have the potential to become global champions in the bioeconomy sector and help them scale up their technologies.
Okay, thanks, Stéphane. Thanks, everybody. All right, so by kicking it off, I would like to go back a bit in time. A trip down memory lane, I call it. I'm a bit nostalgic, so I like to look back and see how we can learn from the past to take those lessons into the future. In the 2000s, we had a big wave of bioeconomy startups and scale-ups, mainly driven by the US and Silicon Valley. Lighthouse companies like Gevo, Amaris, and Codexis were also focused on drop-in chemicals, biofuels, bioethanol. Big promises, right, that we made. We were going to, let's say, outcompete the incumbent chemical industry that was, let's say, not an unambiguous success, with IPOs that were also not a very big success. And also all of those companies, which by the way still exist today, they all pivoted towards, guess what, highly valuable chemicals or materials like sustainable aviation fuel, like cosmetics, and like pharma and food, for all of those three companies. Now, in the recent years, we had also a different trend. Companies like Zymergen and Ginkgo Bioworks, they really hit it off with machine learning, lab-based services to supply to the chemical industry. And the question to the panel is, let's say, these trends are reminiscent of an emerging industry, I would say. Are we finding our path, and what will it take for us, as venture capitalists and start scale-ups, to, let's say, build the new billion-dollar company that really has products as an output? Maybe Stéphane, I see you smiling.
Yeah, no, I can give it a start. I think first there was maybe the belief that these bio-based chemicals would attract, you know, a kind of a green premium, and that the cost competitiveness maybe might, or the time it takes for these technologies to get to cost competitiveness might then be bridged, you know, for certain emerging markets by this green premium, right? And it has not materialized to a great extent. And we see these markets that you mentioned in which these companies have pivoted, so personal care, specialty chemicals that maybe are starting to provide this green premium, but are also more niche markets. They are the markets that have the highest traction today, right? So products that are in me, on me, where consumers see the benefit of bio-based products more, I would say, intimately and also more evidently. So these are the markets that are, you know, providing these premiums today and allow these technologies to scale. But they are much more niche. And then the massive amount of capital that went into scaling technologies too fast ahead of the markets was a sink, maybe. Yeah. So I don't see, you know, availability of capital as being the flow here. I see, on the contrary, maybe too much capital as being the flow, and this company scaling ahead of the market dynamics, right?
Mm-hmm. Okay. Rick, you were at the heart of all of those, let's say, Silicon Valley high flyers. What is your perspective on this? And you have been an investor in Zymergen, so...
Exactly. So, you know, both advising some to Amyris and then, of course, investing in second generation ones like Zymergen and Ginkgo. Yeah, there's there's an expression from the Buddha: when is the best time to plant a tree? 20 years ago. When is the next best time to plant a tree? Now. So we tried in the late 2000s, and we got incredibly ahead of ourselves, and you know, unfortunately that sort of crashed and then left a difficult funding environment, frankly, for bioeconomy-based startups, which we are now, you know, starting to undo. But guess what? It's been, you know, 12 or 13 years that we've sort of, you know, missed progress on. So, you know, specific things about that first, you know, generation. It took advantage of the fact that the price of sugar and the price of oil were flipped. Yep. And this was just a market excursion. So for 2 or 3 years, it made sense to produce everything from sugar, and then it didn't. And so a bunch of those companies crashed and burned, and frankly, strategically, it never made sense to go after biofuels. It's a low-margin product, and you're going up against entrenched competition. This is $1 trillion industry. You know, any economist would have said, why do you want to go into a commodity market where the capex is huge? You know, everything. It was a poor choice, and so it failed for standard, you know, economic reasons. Something that, Stéphane said, there was no green premium. 5 or 6 years ago, Josko was on a stage in San Francisco, and he was talking about unit economics. Everybody else is talking about biology, and he's talking about unit economics, because at the end of the day, these are businesses powered by biology, but businesses, and so they have to have unit economics that work. So I think that's our next our next challenge is we shouldn't have had to learn the lesson, but we did. These are bio-based businesses, and they have to survive as businesses by themselves. That first generation was just more about promise.
So I see this as a great takeaway lesson already, right? For every start and scale up here in the room here, I mean, take biology as an inspiration for the future and as a sustainability aspect, which is incredibly important. But I mean, I like the word unit of economics, and Josko, please add to that. But if you don't have a long-term business plan where your margin is at some point making it work, and not only due to some market fluctuations, then I think maybe you're on the wrong path, and you want to steer your startup in the right direction, that it makes economical sense. Otherwise, you will be dead on arrival with these parties here to get funding, right? Josko, do you want to add something to that?
Two things, okay? One is that, unfortunately, okay, we would think that history would be a good, teacher, but we have seen these things repeat in the last 2 or 3 years in an adjacent field, which is related to alternative proteins and let's say cellular agriculture, okay, where incredible opportunity, starting technologies, okay, and total mismatch between expectations, valuations, and ability to deliver on the economics, okay, and on the timelines, okay. Because one of the things that entrepreneurs underestimate is understanding how a venture fund works, okay? And this is important when you're talking to venture capitalists, as opposed to talking to the government or somebody who has infinite timeline. We have a fund lifetime of 10 years, so that means that we have to identify a company, help it develop itself, and then sell our stake within that maximum 10-year window. It's never perfectly designed for 10 years, so that's a constraint. Unfortunately, we're still in a field where companies, unlike other sectors, are forced to go from bench discovery all the way to being able to produce something and sell something. There's no other field where you have to modify and evolve the skill set of the company that much over its holding period for an investor, okay? And that's a huge pressure. But we cannot get away from that until such time where we can actually demonstrate that this path works, that we've done it, I don't know how many times, okay? And then other actors will say, okay, now we'll start acquiring these technologies sooner rather than later because we know that this path is actually reproducible.
Okay, thanks.
Can I comment there? Because I just have
naturally, it's a panel discussion.
I love it. I love this. Obviously, we share a lot in common. The way I think about it, there's different funding mechanisms. Venture capital is really for the exotic, weird peacocks of companies. It doesn't apply to many. You have to have, the discount rate. So talking corporate finance here, the discount rate that we use is generally 30 to 70%. So you need to be doubling every 2 years. If your company was a cell, you would call it a cancer. I mean, it's just crazy. So that doesn't mean that you don't have a good idea or an idea that's going to change the world. But as Josko said, it has to fit, to be investable by us, it has to fit in these very narrow criteria. It has to be, basically doubling every 2 years, and we need to be able to sell it on to somebody else within 10.
Mm-hmm. So maybe, Rick, building on that assumption, isn't it also good, let's say, internal reflection for us as VCs to mitigate that expectations and take the companies along that path? Because cancer rarely has a good outcome. So if we don't adapt to that as financiers, should we also be a bit more, let's say, flexible and anticipate that fundraising and take these entrepreneurs on track?
Yes, I believe.
Madelon.
Sorry.
No,
So we are not
please, you
a
take
long-established company yet. We are established now for 5 to 10 years, depends on which part of a company. And we are called unknown because we do it differently. Normally you say, seeing is believing. We turn it around. We say, believe it, and eventually we will see it. And we are in there for more than 10 years. We are in there for the time you need and to expand. On the other side, we are not only an investment company, we have more than 90 people at the moment, and that's normally not an investment company, but we also have a lot of agreements with a lot of corporates in the world because they are struggling as well, how to innovate, how to do the circular economy, etc., etc. And we believe in building venture engines, as we call it, to bring those two parts together, because the founder needs the industry to scale their solutions. So we make it a more together job to fix the future. And that's also, it's not about, and I'm a CFO, I'm a former audit partner of EY, so I'm only into figures. And now I have to learn, don't look at the figures, it's early stage, look at the team. Do you believe in the team? Look in their eyes. And then I'm saying as a former auditor, where are the figures? Yeah, there are no figures. And if I believe it, then we will invest.
So your religion, really. You know?
Yeah, fully. Different. Look, I'm different.
Yeah, and that's a good point about finding your partner. Again, this is for the startups. Most venture funds have specialization. So they might concentrate on certain geographies, Europe, US, or even more narrowly, geography, subject matter. Some are AI funds, some like ourselves here are interested in biology, etc. Find that out before you go talk to them. Stage, that's another big distinguishing criteria. Some like us over here, we want to be early on. Others are stage agnostic. They'll do in any part. Find that out before you talk to that VC. It'll just help a lot in maybe getting to a yes.
So Rick, the take-home message here is that any corporate should find a good match with the VC, not in terms of culture, but also in terms of stage, in terms of approach.
Yes.
Okay.
But culture is as important, right? Because some people may like you, other people may like me better, okay? And so they should work with the person they like better, they can work with. Because, I kind of jokingly always say that venture investment is like a marriage with a predetermined divorce down the line, okay? Because, we need to go through ups and downs of everything that, an investment will entail. But at the end of the day, we need to separate because we need to get our money back. But that relationship is critical success factor.
Mm-hmm. It's like a marriage contract, so it's not so romantic, but please close it before you enter it, because it will cost you less down the road.
Yes, there's a great phrase: "Marry in haste, repent at leisure." So you are going to. I mean, particularly in the early stage, again, where I spend a lot of my time. With some of my portfolio companies, I'm having weekly hour check-ins. Yeah. So if you don't get along with that person, if you don't actually like spending time with that person, it can be very difficult, very toxic. So there is this cold-blooded financial part to it. Is this going to make money for me?
It's a good me.
But then there's also this part of can we get on as investor and investee together to make something happen?
Okay. Maybe changing tack a little bit on the current climate that we are in. It's needless to say that we're living in a bit of uncertain times, depending how emotionally let's say, immune you are to all these signals of inflation, geopolitical distress. But let's face it, all of these dynamics, Corona, by the way, they had their impact. They had their impact quite severely. If we're talking about bioeconomy, we talked about premium products, we talk about, let's say, first stage introduction into higher, let's say, cost, or let's say higher priced products. So you would say these inflationary environments do tend to maybe even benefit this sector. Well, we have not seen that. For instance, in the sustainable proteins business, we have seen that all the yogurts that are based on alternative proteins have tanked. Every consumer tends to go back to the basic products, the white label products. So all your innovation, even if you went to the shelf, sorry, but you're in trouble. Add to that a lot of costs, right? I mean, I live in Belgium. We have an automatic indexation system for wages. I can tell you,
Like you.
I mean,
Yeah.
it's a big worry if your top line doesn't follow. But even beyond Belgium, in Europe, in Germany, I mean, how many strikes did we have in, well, it's pension related, Stéphane.
Why are you looking at the French guy here in the room?
Well, let's not go into that. So, how do you deal with these economic distress factors in your portfolio, and how do you anticipate the corporate finance onto that dynamic? Maybe,
Yeah.
Stéphane, can you?
Well, first, being solely focused on Europe, we have one element of arbitrage that we don't have, unlike other funds like Sofinnova. But I think the volatility of the energy environment and the cost pressure there is, especially, is asymmetrical. Yeah, it's not global. So it plays in favor of certain geographies. So if you want to think CapExes, obviously investment decisions will be premised on the more stable or the longer-term competitive environment. And the US has a hedge, I would say, over Europe in terms of the energy costs. So that's one element to take into consideration. Being more focused on our portfolio, I'd say we see, and the market in general in Europe, we see a need for companies to take a bit more money, plan longer timelines for commercialization, and so we see also more internal rounds being made, convertibles, extended Series A, Series B, and so obviously companies are taking in money, and if they can take in money, they should, take the money if it's around the table, because you may need it. You think that's the last round, but it's never the last one. No. It may take longer than you think. So, yeah, that's a trend that we see.
Mm-hmm. So one of the challenges for everyone, including VCs, is that nobody, except for people that maybe lived in Latin America, has lived through inflation. So they don't understand what it means. Okay. But if you have a 10% inflation, that means that $1 million invested this year in a company buys 10% less 1 year later. Okay, and that's material. That's a lot. Okay, so one of the things that we have done is clearly, pushed companies to raise more money, and also to think carefully how they're allocating their capital. Because in the heyday, you can make mistakes, maybe overhire, then you clean it up a little bit, okay, let some people go, but you have money, so it's not a problem, okay. When you don't have money and your money is worth less down the road, then you have to think about that from day one, okay. From the investor perspective, okay, we have capital that's promised to us. That capital is not sitting in the bank and earning interest, it's a pledge, okay? And so our money every year is also worth less, okay? And we have to think about that when we're projecting how we're going to invest, okay? And so an allocation of, 10 or 15 million per company 2 years ago was worth more in terms of what it can buy, in terms of results, than it is today. And we don't know how that future will look like, especially in Europe, where the interest rates are not following the inflationary path, okay? And that's clearly, hurting a lot of European investors. So all of that is in many ways unknown territory for many people, okay? And we need to figure out how to navigate that.
Josko, I want to build on that, because that also has an impact on the pricing that you set on the assets that you would like to acquire. And that's a valuation per se on the company that you put out. So how do entrepreneurs can let's say, can you give some advice? And of course the question is open to anybody in the panel here, to entrepreneurs on, and it's always the elephant in the room, to see where is a decent valuation.
So,
Okay.
oh, did you want to finish?
Maybe finish and then we move on to
Yeah.
Rick.
Every time we invest, we have that conversation, okay? And I haven't heard that somebody has gotten out of that conversation happy, okay? Neither the investor nor the entrepreneur, okay? But what we try to do is we try to think from the back end, okay? And so, because the public markets never lie, okay? And so we know that a business at some maturity is worth a multiple of EBITDA or sales, okay? And so we know what's the end game, okay? And we try to explain to an entrepreneur how much capital the company, or estimate how much capital the company may need, and what are the value creation steps down that path and inflection points. And so then you come up to a discussion where if you overvalue your company now, you'll be hurt next time around, okay? And then at the same time, from an investor perspective, if you undervalue the company, the entrepreneur will not be happy with it, okay? So you'll have a problem. You'll have to find ways to incentivize the entrepreneur differently. So finding that equilibrium is not science, okay? But it's a question of understanding what it entails to take the company somewhere, okay? And at the end of the day, when the company runs into problems with fundraising or valuation issues, the people that suffer at the end are investors, okay? Because without the entrepreneur, the company is not going anywhere. With investors, you can always replace them.
Rick?
No, please.
Go ahead first.
Wow. Yeah, I was going to, simply say that there is a market for money, and the price of money moves up and down just like the price of apples or any other commodity. And for about 5 quarters, starting in the beginning of 2021, there was a huge excursion, and there was loads of money in the venture ecosystem. That led to great terms for entrepreneurs, and then it went away. And so the price of money is expensive again. And so it's as Josko said, we can't argue with the market. It is what it is.
But keep in mind that I liked what Josko said, is EBITDA and revenue at exit.
Mm-hmm.
We did an exit last year. The company that acquired the asset was only looking at EBITDA and revenue. And luckily, the EBITDA and the revenue was there, and the multiple was accordingly. But it was not rocket science. It was not like $1 billion IPO, right? With no revenue or little revenue. So please keep that in mind. Sometimes reality hits you, but it only hits you in the end. And it's difficult for an entrepreneur to refuse a high valuation, of course, Rick, because in terms, as you say, the commodities, the pricing mechanism works. So.
Right. And it's hard because, of course, on the entrepreneur side, this is usually the first time and possibly the only time they're going to go through this process. And so they have, little understanding of what I do today, the decision I make today actually makes a difference 5 or 6 years from now. That sort of thing. Another thing that I think is sort of my understanding of how startups work is, at the seed stage.
You do understand? I don't yet.
So poke. Thank you. Yeah, I mean, at the very earliest stage, you can come to us with a pitch deck and an idea, and it's more about the story, and you're going to be funded on the story. As the business grows, it becomes less qualitative, more quantitative, to the point where if you're super successful, all you are is a cash flow with certain characteristics like your volatility. And they're going, a super sophisticated investor is simply going to say, okay, you're producing 10 million a year and you're not correlated with this other investment that I own. They don't care if you're making, computer chips or potato chips. It's just the cash flow. So they're gonna, if you're successful too, that's the other thing is like, don't run away from that. if you get there, that means you're a big success. But
I'd like also to get Madelon's input on that, because you want to build on that?
Yeah, I want to build that if possible.
Yes,
I fully agree. There was revenue EBITDA, but I only focused in the beginning on cash flow.
yeah, so now it's new.
So
Well.
I don't care about. Of course, it's the outcome, but for me, revenue and EBITDA is just the outcome of the business. It's a figure. That's it. It's all about cash. And also in the start, what you were saying, really early stage, you say the model. We really look at the team. The team is the most important, but also early stage is also the founder capable of stepping aside when the company is growing, when other qualities are needed. So if we're speaking to a founder of a startup, that's really where you have the feeling already he wants to bring it to the end, but we know, for example, that's an engineer or it's a biochemical or whatever, but not when the company grows is sales or commercial, then we already think at the start of that team, is it the right team to bring the company to the next stage? And so we focus purely on the team and the cash flow. And I think what is very important, we normally start really with convertibles, not with an equity stake. But which kind of KPIs do you put in the convertible loan agreement to convert? Is it realistic? And especially in these times when the economic crisis is going on, we notice that a lot of our investments don't reach the KPIs that they promised. And that it will cost them an extra discount if we are going to convert. So be reasonable, be fair to yourself in discussion with a venture capitalist. And it will always be, as you said as well, it always be a fight in that discussion. But be prepared. And don't come to us with a pitch deck. To be honest, we are a little bit different, I know. Because we really look at the team and be aware of the fact that you get the questions from the management or the investment about the team. We have, of course, our specialists on the proteins, etc. I don't know anything about it, to be honest. I focus on the team and the financials, but only cash flow.
Controversial question, Madelon.
Yeah.
Can you put a percentage on, say, if you see entrepreneurs, 10 entrepreneurs, right? What's the percentage of entrepreneurs that come to you and you are a financial person?
Yeah.
This valuation, I think, is more or less in line with what I believe the company is worth.
Really? 2%?
2%.
No, we have, but be realistic, of course. And I'm of the opinion you have to be higher, of course, because it's give and take in the whole process. That's also, to be honest. If I'm selling the company, I will do the same, of course.
Okay.
It's the beginning, it's the other way around at the end.
All right. We are blessed with a little bit more time, but we're 7 minutes from the coffee break. So I would like to look at the audience now. I mean, you have the chance to get some questions. Don't be shy. Let the question now come and don't wait for a coffee break. Is there any question in the room, a burning question that you might have? So either people are shy, not awake, or aha. You have a question there from Norbert.
Hello, good morning. My name is Norbert Baumann from Helm. I would like to come back to this, what was discussed in the early stage of the panel discussion, where you basically said unit cost is important, right? Now the problem that these innovative materials, companies, whatever, are having, is that they typically come at a lower scale when they go into commercialization than the established products, right? So that means the unit cost per se will be higher than what you have as conventional products. Therefore, a premium, where you basically also mentioned that this is difficult to be achieved, somehow is required to sort of make the whole thing work. So how do you address this? Because this is something which only with the, let's say, second, third, fifth unit can somehow be addressed as technologies get further scaled up. But with the initial commercialization step, I think it's somehow unavoidable that you work towards a premium. Otherwise, you're not having an equivalent case right from the beginning, right?
Josko?
So there's a bit of kind of a conflict in what you said, okay? And I'll try to explain what I mean by that, okay? If something is called commercial, it needs to make money, period, okay? So in that sense, what we understand is that, of course, any startup at a small scale initially is not going to be commercially viable, okay? But when we invest, we need to understand what is the path and what is the size of the unit they need to build or production facility they need, okay, where their business will be economically viable, okay. And this is a projection, of course, okay, with some error of margin, okay, a margin of error, but that one informs us whether the company will need 500 million, okay, or 50 million, okay, or anywhere in between, or even more or less, to get there, okay. And so that's something we need to assess to say, okay, it is possible to see this company through to the point where their production is going to be commercially viable, okay. Then the rest is going to be about their ability to convince the market their product is worth more because it's better, okay. And here we have two levers, okay. One is that bio-based products, so the ones that are not produced from petroleum, oftentimes, or at least we try to focus on those that have certain performance characteristics that are superior to petroleum ones, okay? Why? Because you can ask more money for that, okay? It could be around toxicity, it could be around better performance, different things, okay? So that's your way to make more money. On the other hand, if you're competing in a commodities world, okay? Today, green premium is a concept that, you know, doesn't get paid, okay? The reality is that down the road, okay, there's going to be a carbon market where you will harness your premium. But today, that market doesn't exist. It's not liquid, it's not stable or anything like that, okay? But tomorrow, when every single company that has made a promise to reach their sustainability targets by, pick your year, 2030, 2035, needs to do that, okay? That needs to happen somehow because there will be a market that rewards people that can make something in a more sustainable fashion. How do we get there? I don't have an answer because I'm not an expert on carbon markets, okay? But we need a way to put a price on carbon because without that, we're going to be limited to high performance, lower volume products that can really deliver something, okay? But we'll not be able to come down and actually create significant impact with volume on more commodity-like products.
Stéphane, do you want to add to that?
Yeah, it's almost a thesis that Josko just laid out. So I'll try to build on it still. I agree with most parts of it. I just adding on the earlier stage of the development of the companies, there, I still believe there are beachhead markets that will provide that green premium that is then the stepping stone to get to scale. If you take, I don't know, for example, sulforolipid surfactants, Holifirm will be presenting here. These are not molecules that are particularly performing as surfactants, but they are green, and that green premium can be valorized in certain markets where that premium is recognized through the brand, right? So there is a marketing premium to it, they are performing equally well, but there is market share that's driven by the adoption of these products in these brands. So these are not necessarily very massive markets, but can help be the stepping stone in getting to that first commercial plant. And then as scale goes, you have economies of scale, obviously on cost, personal cost and capex, that help you progress. I'm a bit weary about having just the carbon as a fixing element for this to work because it's very volatile. It has also, I would say, negative consequences in the way the financial markets behave with it. So yeah. So.
Okay. Thank you. Any more questions? Yes, please.
Hello, Tomasz Ciamurski, founder of Wehbring. If the unit economy agrees and there is a good business projection for you as a VC, but then the business needs scaling factories, building factories, so the capex is large. How do you look at that part? Do you require also industrial co-investors or important partners as operators of factories or other players in this industrialization? Or do you also finance that yourself only?
It's a corporate finance question.
Yeah, exactly.
Maybe Rick,
so either of us, but I'll take the historical perspective, which is in the first generation of biofuels. Okay, biofuels, a commodity. There is no green premium. It's never going to be. We don't look for performance. We just add oxygen and burn it. It's like the lowest use of a carbon compound ever. They realized, though, to compete in a commodity market, they had to go to massive scale because was, 1,000-liter fermenter, you couldn't get the unit economics. So companies like Amyris went, straight to the source. So they built 200,000-liter fermenters adjacent to sugar plantations in Brazil. Still couldn't make it work. It's a hard problem to crack. But the other thing that I think is important to say is use the right tool for the job at hand. Like, so if you're opening a paint can, everybody reaches for a screwdriver. It's not the best tool. You should use a lever. You shouldn't, mangle your screwdriver. In terms of corporate finance, if you're doing something that has massive capex, venture capital is not the right tool. Use something else. Use project finance, debt. If you're a public company, you could take on more debt. Use the correct corporate finance tool, but not VC.
Yeah, I have two examples. One is that we have one investment that is now in the stage of big capex, and as a VC, we help them, as you said, with the next finance of the capex. On the other side, we believe that founders need industry leaders to scale quick. So we work together, for example, in the energy sector with the ENI, with Shell, and then together with the founders to scale quick, because most of the time they have already much more money and also maybe some capex that you need as well. So we believe in working together to get that quick run into the new energy and the new proteins, alternative proteins. We do have to do it together.
So also just sort of in that vein and at a sort of a planetary scale, right? We're undergoing this energy transition, and what you don't want to do in general is what we call in the trade a forklift upgrade, where you bring in a forklift, pull up your old equipment, toss it out, put in new equipment. That's extremely expensive. If you could, you'd like to reuse existing plant capacity that's out there. So where are we today? We're in Fokker Terminal, which used to be an aircraft production or aircraft engineering facility, and now is a conference space. Oh, good, that's smart. We're reusing this space. We're not just tearing it down and building a new building. There is the scale partners exist. They already have. Look to the chemical giants already right now. They have massive, chemical plants. Can any of that be repurposed? Much better return on capital. And it's not just the money. Again, if we're going to do this, we need to do this fast. Greenfield construction, gosh, if you're lucky, 24 months, but, there's permitting and everything else. We want to bring on a lot of bioproduction, and again, I think the personal opinion here, the fastest way is to reuse the things we already have.
Yes.
So the answer is it's not unambiguous, but talk to the people, talk to your partners if you're unsure how to, let's say, provide for the right financing for your plant. It could be that multiple partners come on board in different stages of your pilot demo to do this. And the solution is not one fits all. Venture capitalists always color outside of the boundaries, outside of the lines. Same with time. So I look at Paul. I have time for one short question. And I saw somebody in the back who had a question. Sorry, I have to pick one. I think you were first there in the row, in the aisle.
Yeah, hello. My name is Ivanov from Morty. So very quick question. I noticed you spoke about the bioeconomy investing and the macro. But on the specific sector side, so what do you think that it is true for these kind of verticals, so on the bioeconomy, for funding, and specifically for a founder to know on how to best secure funding? What specifically of this sector that is not on the others, and that it can be better for outperforming or underperforming, and that it is true today?
If I understand the question right, is this which sector is the most viable?
No. What is true for this sector that it is not for the other ones in terms of investment? Yeah.
Do you understand the question?
I didn't understand the question. Could you rephrase the question?
Rephrasing, sorry. So what is true for the bioeconomy sector in terms of investment that we should pay attention to, not to others different?
So
Something particular
let me try and see if this is right. So what is different about investing in a bioeconomy company versus, say, an AI company? Okay, is that right? Okay. Well, I'll take one stab, which is time. These are deep tech investments, and they take a long time to mature. And the problem with that is, of course, this discount rate discount rate and general hard stop at 10 years. That makes these difficult to fund. I was looking at the presentation by AMS Silk and looking, gosh, they got started in like 2006. I'm like, that was a long time ago. So I think that makes it very hard, again, from Silicon Valley, where people can turn software investments around in 24 months, because there are things like Amazon Web Services, scale is automatic. It's again a difference between bits versus atoms. Bits easy to scale, atoms hard.
Okay. So. Thanks, Rick, for these closing remarks. I want to thank my panel, Madelon, Rick, Josko, Stéphane. Thanks for your valuable contribution and animated discussion. I hope it was valuable to the audience. And with that, I wish you a very good conference and a great networking break. Please approach us, these people, if you have more questions. Thank you.
Thank you.